you're brand new or an experienced investor, investing into ETFs can be among the easiest yet best overall ways to invest in the market and build wealth over time. Now, just so you know, all the ETFs that I'm about to mention in this video are a type of index fund, which means they are passively managed and automatically track particular market segments rather than being actively managed by a professional fund manager. The great part about index ETFs is that they are super easy to buy, really cheap to own, allow for great diversification within a portfolio, and with the right ones, they have historically done very well over time. And so to get straight to it, the first one to mention here is the Schwab US Large Cap Growth ETF that trades under the ticker symbol of SCHG. Now, SCHG has an expense ratio of 0.04%, which means for every $10,000 that you invest, you're paying $4 per year in fees, which is automatically taken out of your investment over time. It's not something you're going to have to pay separately. On top of that, the fund seeks to track the Dow Jones US Large Cap Growth Total Stock Market Index, where it currently contains 229 large cap US companies, with the top ones being Microsoft, Nvidia, and Apple, each having about 10% of weight toward the fund, and many of the other companies here you probably heard of. But the reason the weights are so high to some of the top companies in this fund is because it is market cap weighted, which means the companies are given weight inside of the fund based on their size. And because of that, roughly 45% of this entire fund is tailored toward the information technology sector. Aside from that, over the past 10 years, SCHG has done very well, averaging just over 15% per year. So a fund like this will be more volatile, but over a long period of time, it could very well offer a higher reward. But if you're one looking to reduce some of the volatility, another popular Schwab ETF is the Schwab US Dividend Equity ETF with the ticker of SCHD. This fund also has a low expense ratio of 0.06%. It seeks to track the Dow Jones US Dividend 100 Index, where it has 103 holdings, and the top 10 each have about 4% weight toward the fund, all being strong dividend-paying companies such as Coca-Cola, Home Depot, and Chevron. The largest sector exposure here is 21% toward energy, and over the trailing 12 months, SCHD has averaged a 3.72% dividend yield. And with this exposure, over the past 10 years, the fund has averaged roughly 10.5% per year, which includes dividends being reinvested back into the fund. Knowing that, the last ETF to mention here allows you to gain significant exposure to the US economy, and that is through the Schwab US Broad Market ETF that tracks the total return of the Dow Jones US Broad Stock Market Index. And by investing into this fund, you can simply gain access to the 2,500 largest publicly traded US companies that are designed to measure those of large, mid, and small cap stocks. The fund has a 0.03% expense ratio, which is the lowest of the three mentioned, where the top companies here are very similar to SCHG, but with lower weights due to having roughly 2,500 companies in the fund, rather than 229 with SCHG. And so SCHB is pretty much a simpler way for you to invest into the broad US stock market, where over the past 10 years, the fund has averaged an 11.6% annual return. And so if you combine the three that I just mentioned together, it allows for a super simple portfolio that contains growth, dividends, and total market exposure. Not to mention, but if you are investing on Charles Schwab, they do offer their own in-house mutual funds. And if you want to learn the differences between ETFs and mutual funds as a whole, I made an entire video on that I'll have linked in the description below. And if you want a free template to track all your investments in one place, I'll also have that linked below as well. Which, if you found value in this content, don't forget to hit the like, subscribe, and notifications button for future content like this.